Hello everyone, welcome back to our Accounting 210. In this video, we will continue with our Chapter 10 Performance Evaluation. Last time we finished our learning objective 3, we talked about ROI, sales margin, capital turnover, and then also the residual income. So in this video, we will focus on learning objective 5, which is the prepare and evaluate the flexible budget performance report. So we will have a new terminology called flexible budget, or the variance. Remember when we did our learning objective 2, we introduced the meaning of a variance, and then it's favorable or unfavorable. Learning objective 5 is built on learning objective 2. So now let's get started, okay? Make it larger. I copied all these things from your textbook one more time. My handout is just the guideline of your study. So you cannot just say, hey, I read your handout, I will know everything 100% clearly. You have to go back to a textbook and get an overall picture, and then watch the video and then do the practice. And then you want to go back to a textbook one more time so that just to make sure you get everything you need for the exam. The master budget is, we said we do this, remember in chapter 9, you have to have the master budget. You prepare everything for the operation and then also for your financial part, right? So we generate our budgeted operating income and budgeted our balance sheet. Remember that. So we learned that in chapter 9. So that's why we said chapter 9, chapter 10, and chapter 11, they are connected. We look at the budgeted operating income. We look at the budgeted operating income. So you have the sales volume, number of the cases you budget to sell, and then from there we have our sales revenue, right? So each one, our sales is budgeted to be at $20 for each. We minus our variable expense, we got our contribution margin, we minus all the fixed cost, we get our operating income. And then the first column here, we still use the same company, the tortilla company. We have the actual. So after you really made the sales, you have this column called actual. We said actual always goes first before the budget. So your left side is always the actual. And then you also have this master budget, right? You also have this master budget at the beginning of the year. So your actual is, you have this one on January 31st, but you made this master budget. At the beginning of the month, right? We said you have this budget on the first day of January, and then your second part is the master budget. We know most likely your budget is different from your actual, and in our accounting we have a fancy name. We do not call it difference. We use the word is the variance. So now let's look at each item and then say what's the variance look like. I still use the rainbow, I like it. For the sales volume, you budgeted, you will have 30,000. Hey, this color is too strong, right? This color is too strong. We don't want it. Sorry. Let's see if I have a better color. So no. Sorry about that. Sorry. Okay, I still use the traditional. So you budgeted, you thought you will sell 30,000 units, but actually you sold more. You sold 32,370 units. So this is the number of units you sold. You sold more units than the budget, so the variance is 2,370. That this will increase your operating income, yes or no? Yeah, right? You sell more, you will have more revenue. So that's why we have this favorable. And then the master budget variance is just your budget, the variance divided by your original number. So you get also this variance percentage is 7.9%, but I don't really worry too much about this percentage. In this class, we focus on this absolute number. We focus on this absolute number. So your first line is the units. The first one is the number, and the sales revenue $20 each. So you use your actual units you sold time the $20, you will get your actual revenue. You use your budgeted 30,000 units times $20, you get your budgeted revenue, and then you find out that hey, your actual definitely is more than your budget because you sold more. So our revenue is $53,874 favorable, right? So you do this, you also do everything there. Cost of goods sold, each one is $12, sales commission, shipping, bad debt expense. So you have all this actual, you have all this revenue, and you can find what when for the cost part, your actual cost of goods sold. Let's use this example. Your cost of goods sold, your actual is $391,540. $540. Your budgeted is $360,000. Your actual is more than your budget. So you have $31,540 more. But this is the cost. This is the cost. So for this part, it will be unfavorable, right? It will be unfavorable because you have more cost. You have more cost. So you do everything there. You found out that your actual contribution margin is small, higher than your budget. So you have a favorable the contribution margin variance. And then you have all these fixed costs. You have all these fixed costs. You can see some fixed costs, they are actually just zero. In your chapter, we take zero as also favorable. We take zero as also favorable. And then you find out your budgeted income is $97,200. Your actual is $106,944. So you have the favorable variance, right? You have the favorable operating income variance. So this gives you general picture of our variance analysis. So what we did is we said you always have your actual. You always have your actual on the left side. You always have your actual on the left side, and then you have your budget, master budget on the right side. The difference will be called master budget variance. Master budget variance. Okay, but we can break this down. We can break this one number actually to two sub-variance. What's the meaning? Hey, Professor, what's the meaning? Think about your exam. You have a problem part. You have a multiple choice part, right? So you can just look at the overall. You said, oh, my actual is I got 90, and then my budget is 80. So overall, yeah, I have a 10 favorable, right? I got 10 favorable, but I don't know, is it because of the multiple choice or because of the problem? So kind of you can break it down. So we said, hey, for the multiple choice, your actual is 65 and your budget is 63. So now you have two favorable from your multiple choice. And then from the problem part, you thought you will have be you thought you will be 17. Let's say you thought you will be 17, right? You thought you will be 17, but actually you got 25. You got 25. So you have 8 favorable from the problem, right? So you break this 10 favorable to 2 favorable from multiple choice and from 8 favorable to problem. So you can conclude what? You have a conclusion is, yeah, overall I did well. And 80%, the 8 points favorable is more from my problem. So next time, hey, I did well in the problem. Next time I want to work harder on the multiple choice. Why we break down the overall number to 2 parts? so that you can have more stories, you can have a better solution. Hey, hey, my problem, I really did well, but next time I want to focus on the multiple choice. So we break this one number to two parts. Similarly, for the master budget, instead of just looking at this number, we want to break it down to two parts. The first part is called a flexible budget. So you have this one called a flexible budget variance. You have the second one called volume variance, like multiple choice part, problem part. Then you have the flexible budget part. You also have the volume variance part. And we talk about the detail in the next video. So hang on there, and then I see you in the next video. Thank you.